increase this, they want to increase, right? They want to increase company performance, and they want to apply some of the operating plans, standards, budgets, and deviations. Deviation, nothing but will compare standard to actual, right? Standard to actual. If the deviation is very high, the deviation may be positive deviation, negative deviation. So using the technique, we are controlling the cost. Management control the cost, right? Coordinating operations. So management, there is so many departments out there and so many functions are there. So these management accounting, they are integrating, they are coordinating one department, the department, and see that how the department performing, how the process is going on, any process is delay or not. Like they will check in each stage-wise level. And the reporting, the management accounting always reporting the information to the management to take the latest position. And based on the latest position, the company can predict next 5 years, 10 years, 15 years, 20 years. So these objective of management accounting, providing basic data. So what can they are providing? They're providing the past data and present data. So the manager will take a decision. So the management party, they want the management accounting is only providing information. Say that they aren't give any say that is right or bad. So you have to, the management have to take the decision, right? It is a different alternatives also they're providing. So we'll go for alternative 1, 2, 3, 4. So which alternative are going to company's performance as well? Okay, long run as well as short run. So helping the organization, the management accounting help the organization and both human and non-human resources that can be useful, successful. What are the tools are available? What are the tools or techniques using for management accounting? So first and foremost, one is very important, financial planning. Like it's also very required for any financial, right? So the financial resources are very limited. Financials are very limited. All the resources are, the financial resources are paid resources, right? If you borrow funds from bank, the management want to pay the interest, right? So see one by one, budgetary control, managerial costing, historical cost accounting, decision accounting, standard costing, analysis of financial statements, and revaluation of accounting, control accounting, MIS, management information system, statistical technique, and final one is ratio analysis. Like these are the tools or techniques available for in management accounting. So we'll go one by one. The first one is financial planning. So financial planning, right? Every firm has required the finance. Finance is a lifeblood. So without finance, the firm cannot do any single activity, right? The financial planning involves either both short-term as well as long-term objectives. So short-term, nothing but in a finance, what we call less than 1 year, and long-term is maybe 3 to 5 years and 5 years and more. It depends, right? So how the firm can mobilize? So company wants to, the company facing a problem for short-term finance, they can approach a banker to solve this short-term problems. No, the company wants to long-term, they want to start a new branch or new venture or new plant. They required they required a capital. Again, there is an option for either they can issue the share, equity shares, or preference shares, or they can take a loan. So which one is best? Which one is better? Either taking a loan or issue a share, and issue a share, either equity share, preference shares, or issue the bonds or debentures. So which one is better and which option the company gives the good results? Okay. So when it is decided to raise the fund through either loans, and management decide they can take a loan or borrowings, short term and long term. So all decisions are very important in financial planning. So let us say that one more thing is capital structure, how the company is capital structure. So nothing but the financial plan, nothing but it is a liability side of the balance sheets. So what are the items in the liability side in balance sheets? What are the items? No? What are the items in the balance sheet liability side? Equity share capital, preference share capital, right? Debentures, long-term loans. Then it comes to the current assets, current liabilities, right? And so which combination, right? Which capital structure the capital structure is a very important to the firm go for either debt-free company or debt company. Okay. So second important technique tool is budgetary control. So the most probably used for devising management is budgets. Why the company? No, even the government is also preparing budgets. The government is also announcing every month, every year, 1st February, central government, and either March 1st week or last week of February, the state government is also announcing their budget. Why the government is announcing budgets? So budgets see that there is a boundary of doing activities. So these budgets say that what kind of products you're going to produce, and what can the next 5 years, next 2 years, next 1 year, how much if they say that next year we want to increase the sales in 5 lakhs to 50 lakhs. So our target is very clear. We need to increase next 5 years our sales 5 lakhs to 50 lakhs rupees. How much additional capital we require? Additional manpower, how much manpower is required? Right? How much material is required? So where the material is available? So capital is either you can go, mobilize your own resources, or you can go for taking a loan. So which one is better? So like budgetary control is a system that restore management, planning and controlling, coordinating different activities like the production, distribution of goods and services, and design. Right? So third one is, it's a very important and very useful technique or tool is marginal costing. Like marginal costing. So see the marginal, how much margin is there in a costing? So like now in marginal costing, cost can be classified or divided so many types. See that here in marginal cost, nothing but the cost is categorized variable cost and fixed cost. So variable cost, nothing but is a marginal cost. Variable cost, nothing but is a marginal cost. The cost can be again classified into fixed cost, variable cost. Similarly, it is avoidable cost, unavoidable cost, operating cost, non-operating cost. Okay. So like a short-term cost, long-term cost, like cost can be classified different ways. But in our management accounting, we are classified cost into only two types. One is marginal costing, nothing but a variable cost. The second one is fixed cost. Right? So in marginal accounting, the cost can be classified how many types? Sri, how many types were classified? How many types? Hello?
Yes, sir.
Yeah, how many types the cost can be classified?
Fixed and variable, sir.
Fixed and variable cost, right? Wait. Okay. Then next, there is a method. This is a method of cost which concerns the cost resulting change from the value, right? So see that up to certain level, I will show the graph. So this is the graph. So fixed costs remain constant. Either you can produce a single products or you can produce 100 products. The fixed costs remain constant up to certain level. But the variable cost may differ for it. If the production increases, the cost also increase. See like this. So here 0 products, no, there is no variable cost. So if you want to produce a product in 50 units here, the cost increased. So this is the total cost curve. Okay, this is the total cost curve. Okay. So the management to take the advantage of this marginal costing. Okay. The next one is historical cost accounting. So word itself indicates historical, right? We can't change, right? We can't change. Historical cost accounting system accounting that record all the cost transactions incurred as soon as they can take place on a date immediately after this occurrence. So historical cost accounting data is provided historically. These data can useful this future transactions. So decision making, one of the most important functions in management accounting is decision making involving choice of several alternatives, right? So if alternatives are more, we require for decision. So only one alternative, there is no need for decision, right? We have only one option. So when we go for decision making, if the more than 2 alternatives are there, right? In a management, there are so many alternatives are there. Like example, already I told you, either you can do the work through manual or system. or you need to replace this manpower into technology. So what is the impacts of your productivity or your efficiency? This is one alternative. Second alternative is either you can, like earlier I told you, either you can buy a product or make a products. So like, the MRF, Mahindra and Mahindra. So there's an automotive industry, right? So again, there is a question of Mahindra company. They want to make a tire or they want to buy a tire. So which option, which alternative is good? Either they want to make a tire or they want to buy a tire. Anyone? Which option is good? They want to make a tire or they want to buy a tire. So tire is, without tire, there is no vehicle movement. Hari, Sri?
Sir, make a tire, sir.
Make a tire. So what are the advantages to make a tire?
They can reduce.
We can sell.
We can sell. So what is the actual outcome of this Mahindra and Mahindra? It's a basically automobile, right?
Yes, sir. Automobile.
Automobile. So again, the question is they want to be either produce a product or buy a product. So if they have a sufficient capital or sufficient manpower, and if they have a good reserves in their capital, good reserves in their hands, they can manufacture the products. Or they want ready to take the decision. Or else a company is facing a problem for financial resources and manpower, all these, so they can go for this, buy the products. So if you buy a product, the tire company always they can increase the price rate, right? So there is no, they always change the price rate. Okay, there is some pro and cons are there each side, right? So here the management accounting providing the alternatives. Which alternative is better, right? Which alternative is going to increase the company efficiency, effectiveness, and profitability? The sixth one is the standard costing. Okay, the standard costing will always compare standards to actual in 4 ways: either material, labor, and overhead expenses and sales also. So, I think some of you working in somewhere, right? And the targets are company fixing a target, right? And what basis they're fixing the targets? The salesperson, right? Salesperson, there is a target. So every month the sales may be either say that 1 lakh, 2 lakh, sell like. Why they are fixing the sales targets? Why they're fixing the target? So it is Ravi, it is a management accounting, Ravi. Okay. So right, standard costing. So standard costing will fix the targets. Salesperson every month they have to at least sell the 5 lakh rupees sales. If the 5 lakh is more than 5 lakh sales is okay, no problem. If the sales are less than 5 lakh rupees for continuous last 6 months, say that the salesperson is not doing effectively, so we'll address the problem. See that we fix the target, the production final cost of product is maybe 90 rupees, including both primary cost, prime cost, works cost, factory cost, all costs. But in actual, the cost may increase 110. So there is a problem for cost also. Our target is we can produce a product is 90 rupees, but actually it is 110. Right? There is a difference. So why the difference happen? There is a question mark. Right? So labor cost. So we say that labor cost is 30 rupees is standard, but it is 45 rupees. Again, why the cost is increased? Okay. We know that we will analyze why this increased, why it is increased. Okay. So like the standard costing, variable costing is also very good technique. It's also useful to all these MNC companies to control these expenditures. Okay, standard costing technique compared to standards of material, labor, and expenses, including the production. And analysis of financial statements. So why we are going to analyze the financial statements? At the end of the time, at the end of the period, so the firm wants to know this financial position of the company. Right? This income statement, balance sheet doesn't speak anything. So we will change the data. The data is same. The income statement and balance sheet, the data is same. But what we can do is we will change the data as per our management requirements. They can prepare comparative statements, or they can prepare ratios, fund flow statement, cash flow statement, commerce statement, and these statements are providing information to take a decisions. The management will take a decisions. Only to see the balance sheet and income statement, so it is very difficult to take a decisions. Because the raw data is there. Right? The raw data into will go for this applying the techniques. We know the company profitability, or company efficiency, or company solvency ratio, company risk perspective. So like we'll see all these and see that here the finance statement reveals the past performance of business in respect to dividend payout capacity. The company is ready to payable or not of dividend policy. Either they want to retain the dividends or they want to pay. If they want to pay, the cash is outflow. If the cash is outflow, what is the impact in the company liquidity? Right? What is the problem in the company's liquidity? Always is a profit. There is a link between profitability and liquidity. And the nature of debt service. So what kind of debt is there? Is long-term debt, is short-term debt. And if debt is there, and debt, how much interest we are going to pay? Right? Always say that debt is a cheaper source. Is good, debt is cheaper source at the same time, the risk is also there. Okay, how to do this? How to avoid this kind of risk? If the firm is a growth firm, is okay. The company may able to pay these debt amounts. If it is company, the firm is only normal firm or declining firm, the company is unable to pay the interest in his debt cap. And profit earning capacity, how much the profit firm can earn. Okay, solvency position. So solvency position, nothing but the firm paying capacity. The firm has capacity to repay these all loans or not. Right? The company has some kind of assets or not. If the company have the good assets, if the selling this asset, the company easily pay this whatever the liabilities are there. Okay, so like these financial statement of analysis of finance statements, so we'll get the all kind of data and we'll make a decisions. So based on the past data, the future course of action is projected. Okay, projected. And revaluation of accounting. So these also one of these important tool or technique in management accounting, revaluation or replacement of accounting reveals to maintain of a capital or real terms. So whatever we prepare this accounting, financial accounting data based on the book values, not the market values, not the historical, we prepare only historical values. The price always changes. As per changes, we also reevaluating the accounting and control accounting. So management want to control costs using the standard costing, budgetary control, and cost control reports like statements, internal checks, internal audits, and reports also they can prepare. So these are very useful for company to take appropriate decision and implementation of the firm at all levels of management. So all levels means there are 3 levels, either top level, middle level, and lower level. And the management information system, MIS. So management information system, it provides all the accounting data converted into management accounting to provide this management accounting provide all these data and information relevant to enterprise for the purpose. So it is providing the end-to-end data. And with the help of, with the development of electronic devices for recording, classification, reporting, as considering most improved to compare previous year, we'll go for feedback of information can be used for control techniques. So like in management information system playing a very important role to management to take appropriate decisions. It provides all kind of data, either financial data, non-financial data, end-to-end the data is provided. And also we're using for statistical techniques for this management data, like, come up the examples like master charts, sales and earnings investment charts. Nowadays, most of the companies are using various softwares for analyzing data. One of these very powerful one is Microsoft Power BI. It's also very useful to know these company sales, right? The company want to know that which product or sales are good, product wise, period wise, month wise, right? And each branch wise, each place wise, and which area people are buying, which kind of products. So like you can show this total data into various technical, it's very easy to understand. And the very important one is ratio analysis. This is very popular and all companies are using this technique, ratio analysis. The ratio nothing but relationship between two numbers, two numericals. So it gives, right? So what we can do is, so doctor, how we can check that our body temperature, how we can check the body temperature? So Anna Murkindra dangerous Sarma. Anna Murkindra dangerous Samu. We'll check the rice is cooked or not. We'll take 1 or 2 samples, right? We'll judge the rice is cooked or not. Antena kada?
Yes,
Doctor is also saying our chest, our pulses say that our temperature. So like these ratios, so we'll see 2 or 3 ratios, you know that the company is, what kind of company is the risky firm or not? All various ratios are giving directions. See that we can say that solvency ratio, the company is payable or not, right? If you go approach a bank, bank 5 crores kavali, bank they're asking last 5 years balance sheets, all this, right? And just they're asking the question is, so these 5 crore rupees, what we can do? You can do for short-term purpose, long-term purpose. I mean, these 5 crore rupees is required for working capital purpose, or you want to expand your business operations. What kind of purpose is required? So simple, they're asking question is, what is your PE ratio? What is your EPS? What is your EPS? What is your PE ratios? What is your DP ratios? What is your paying capacities? What is your current ratios? Like few ratios are enough to know this company financial position, right? And at the same time, we can go for trend analysis. We'll see the trend of sales, trend of expenses, right? Last 5 years, or we'll compare our trend to industry trend, right? In industry or the one firm, right? We'll compare a trend analysis. Either trend go like this or trend go like this. What kind of trend it is? Okay, and see that what kind of trend it is upward trend, downward trend. We'll compare our trend to our industry trend. At the same time, comparative statements, common sense statements, and these are very useful tools or techniques. Like on the whole, we discussed so many advantages, so many factors, and so many functions of financial management, for so many functions of management accounting, right? Tools, technique also we discussed so far. Then the last part is today's class. What are the limitations of management accounting? So as I already told you, the management accounting providing information only. It provides information for planning, controlling, decision making only. So we will take a decision. We will take a decision. The individuals will take a decision, right? The management accounting is a recent discipline. Therefore, it is the process of developing stage only. And these are some of the limitations of management accounting. Management accounting is a tool, is not a whole, right? Management accounting is a tool, is not a whole. It is still, it is in a evaluation stage. It is not end to end. Like why some companies are going for losses, some going for success, means every company applying to the management accounting, but result are not the same. Like so, over the take a decision, it's own perception. Okay, so still it is in a evaluation stage. There are the limitations of basic records. So whatever the data is there, the management accounting depending upon the financial data. If the financial data is wrong and you take a decision, your decision may be wrong. Why? Your decision is correct, but the data is wrong, right? So financial data is not correct, but you take a decision, the result is not a proper decisions. The thing is, the data is not up to the mark. Something, no, I think you know the Satyam scam. No, even you know Satyam Ramalingaraju scam.
Yes, sir.
Yeah, what happened in Satyam Ramalingaraju scam? It's accounting fraud, right? It's purely accounting fraud. mean they were manipulated the accounts. They are created fake vouchers. They are creating showing that wrong sales, wrong purchases, wrong sales, and even they are always paid the tax, right? So like, if it is accounting fraud, the management cannot do anything. So management accounting basically depending upon the accounting information. If the information is wrong, you can't take a right decision. Okay, lack of knowledge. So all the if the management has a knowledge about the various tools and techniques, they can take right decisions. If the management doesn't have that kind of knowledge and knowledge on particular tool or technique, they will take wrong decisions. Persistent effect. See that persistent effect meant which one is better? A or B, 3 options are there. 1, 2, 3 option. Which option is better? So if you select one, the remaining 2 are you are neglected, right? Intensity of decision. So decision may not be always correct. Is a cost installation. So is a management accounting suitable for larger firm, not the small size and mid size firm. It's always is a larger firm, is a big scale of firm. It's suitable. Costly installation cost is there. The very important limitation is personal bias, right? The person, the management, how they can, these decision based on his personal bias. So you want to say that next 5 years, the company growth is only one product or they go for multiple products, right? So it's depending upon the personal bias. Person to person, the information is same. Like, see the example I will show you how it is personal bias. So this is, what is the number? What is this number?
6.
So if a person standing here, he will see the number. What he feel?
It's 9.
It's 9. If the person standing here, he will see the number. So what did he feel?
6.
6.
So any change in number is same number, right? Number is same. Number
But
is
the point of view and the perception is different.
Yes, exactly. Like this is our financial statements. This is our financial statement, right? This is our financial measure. This is our income statement and profit loss account and balance sheets. This is the same. The only thing is how we are seeing, right? This is a like 6 number showing like, so it is a purely personal bias. The management always sees the resistance to change. And is also always is a high level structure. The management accounting is only providing the data. The management, based on the data, management can take the future decisions. Is also broad-based scope, but we restricted, very limited, and not an alternative to administration. So administration is, we can't. So the management accounting is not an alternative for administration. It's kind of one kind of tool or technique, right? And people always for resistant to change, opposite to change, so they won't accept. Say that if we introduce a new technology in place of old technology, the people, the management, the employees say that if we introduce a new technology, we will lose our job, right? And we'll get low pay. So like there are various opposition changes also happening. So this is today's class. If you have any doubt, please ask for next 5 years for 22 minutes. And tomorrow go for second part, block number 1. Any doubt, Harish? Hello?
No, sir. No, sir.
No, sir.
Wait a minute. Is it okay? I'm going fast or slow? Is it okay? Hello?
It's okay, sir. It's understandable.
Yeah, it's okay, sir.
Okay. Wait a minute. I will take a snap. Okay. Today's class is over. Okay. All of you request you please leave the class.